Morning all. Thanks for joining us. We're going to get into a bit of the information around the budget and some of the other issues that are relevant as well, particularly with CPI yesterday and interest rates obviously starting to change. And we're fortunate to have access to a number of experts from our accounting and our business advisory teams. And to say that they live and love tax and accounting and whatever else is probably an understatement. So it's about extracting the information from them. And I'm going to change the housekeeping rules and just say, if you want to ask a question, please let me know and we'll throw it at them as we're going along. We need to keep them on their toes and make sure that we're getting through the issues that are really important, particularly as things keep changing on a daily basis, as more information comes to hand. Things change overnight and petrol prices keep changing, all of those sort of things. So let's get into it. At the first point, we're going to probably get Marcus to give us a rundown of what he saw from the budget and the key aspects of that and what it actually means, and also some of the economic issues that sort of arise out of it. So there will be definitely some questions, I think, running out of it. So don't be scared to throw them to me and I'll make sure that he answers them as best as he can. And no political answers today. Okay, Marcus, take us away.
Thanks very much, Todd, especially for the change to the rules. So as Todd said, I'm a director in our corporate tax team. So I'm especially excited to talk to you about tax. Unfortunately, there isn't a huge amount going on in the tax space in the budget, but I think what is in there from a tax perspective really sets the scene a little bit for probably what's to come over the next few years. So I'm going to start with a little bit of an overview of the key measures or the key things that came out of the budget. I'm going to give a little bit of information about the economic landscape that's really driving the budget. And then I'll dive a little bit into some of the tax measures that were introduced in the budget. So for those of you who stayed up and watched the budget, the Treasurer announced a 5-point plan for responsible and targeted cost of living relief. So that 5-point plan was made up of, firstly, making early childhood education more affordable. Secondly, reducing the cost of essential medicines. Thirdly, expanding paid parental leave. Fourth, improving housing supply and affordability. And fifth, getting wages moving again. So I'll go through some of these in a little bit more detail. As an overview, there's some really strong measures in there that will help certain parts of the economy or certain people with certain profiles in the economy. I think what will remain as debate in the weeks to come is how well targeted that cost of living relief was and if there was enough cost of living relief. And so if we jump to the next slide, we've included a bit of a snapshot of some of the key points from the budget. So firstly, quite a bit of this information, quite a few of the announcements were things that we probably already knew from earlier announcements, and there are a few additional items as well. So firstly, I think we were already aware that there was some significantly higher inflows than expected in the budget. So the budget deficit was $43 billion than previously anticipated, which is obviously a significant amount. As we'll see in some future slides, although it's a significant improvement, there is still a very large structural deficit. That improvement, we understand, has been primarily driven by much higher than anticipated prices being achieved for our natural resources, as well as the very low unemployment rate driving tax collection in the economy.
And Marcus, they talked about savings as well through this process, but they actually spent the savings as well, didn't they?
Yeah, I think the Treasurer has very much been pushing the point about fiscal responsibility. So whilst there are some savings, particularly in juggling around some infrastructure projects, those savings have essentially been directed straight into other budget measures. So the savings are kind of in and out. So it is responsible, but I think the theme that will come out of this is there's probably either some more savings that need to be found in the future or some ways to generate some additional revenue.
And some of the forecasting was pretty concerning as well around specific areas, particularly in power and energy costs.
Definitely. I think there are a few concerning statistics to come out of some of those budget announcements. So I think there's going to be a lot to be said about power costs, energy costs. I think today one of the potentially New South Wales Premier or Treasurer came out and essentially has implied that the Treasurer hasn't done enough to help with electricity costs. I think that some of the forecasts were that over the next year or two we could see a 50% increase in electricity costs and up to a 40% increase in gas costs. Obviously, that has a significant impact for households, but that's potentially a huge impact for business as well, especially those that are energy intensive. And I suspect Andrew might have something to say about that towards the end of this presentation as well.
Cool.
One of the big talking points before the budget was stage 3 tax cuts. We've got it up on the screen, but technically there wasn't a lot to come out of the budget on stage 3 tax cuts. They're already legislated to apply from 1 July 2024, and the budget has left them as they are. I would say for now, I think there's more discussion to be had over the next 12 months about whether or not those are changed, modified or removed. And I'll touch on that a little bit more in a future slide as well. There were some social investments, so some really good initiatives. So $1.7 billion for women's safety initiatives over the next 6 years, primarily being spent to support the implementation of a national plan to end violence against women and children. One of the biggest investments was in childcare support, so $4.7 billion for additional childcare support over 4 years. I've introduced that as a social measure, but importantly, it's also a productivity measure. So the budget papers are quite clear that one of the upshots of that is that it's expected to increase workforce participation. So put some more skills into the economy and help the economy grow. So there's some good things there. A few $1 billion for environmental and climate change initiatives. I think we expect more of a focus on the environment and climate change from the current government, and we can probably expect more in that space going forward. The next 2 points there are on tax compliance. So the government is investing heavily in beefing up compliance resources at the tax office to increase tax recovery from taxpayers and close some loopholes. And I'll go into a little bit more detail on that as well. The budget had a real focus on affordable housing initiatives. So there was an additional $350 million to build new affordable housing on top of some already announced housing initiatives, in particular, the $10 billion announced for the Housing Australia Future Fund. And there's also some significant funding for fee-free TAFE placements and also some other education measures to make sure we've got the right skills being brought into the economy. Importantly, if you go through the detail, a lot of these measures, most of them aren't instant. They are either staggered or delayed. So you can see that the government is being very careful around, introducing new money into the economy, but not doing it necessarily at a time where we're really struggling with inflation. I think a lot of governments are spooked by the response to the mini budget in the UK a few months ago, and you can see that playing out in the timing of some of these initiatives. So if we move on to the next slide.
So Marcus has been thoughtful about how they've done this to try and avoid any further stimulus into the economy and keep driving the issue, like CPI, as we'll get to, is a problem at the moment.
Yeah, exactly. I think there would be both concern from the government if too much money was being pumped into the economy at the moment, given where the CPI numbers are at. And I think equally, we've seen globally that the markets would probably have reacted quite badly as well had they done that. There has been some interesting commentary about whether or not that will have some unintended consequences, particularly some of the construction and infrastructure measures that have a delayed start or will kick in future years. There are some interesting questions around whether or not that will drive some strange behaviour in the market. Will it push back projects? Will it have some unintended consequences? Potentially, I suppose we'll see. So I think in understanding these budget measures and what the Treasurer is focused on, it's important to have a look overall at the current economic situation and the forecast over the next few years. So I find this table a little bit difficult to read. I don't know why in the budget they present the 3/4 and the halves and the quarters not as decimal points, but you can see here some real themes coming out, and these are the things that I think we'll be discussing in the months to come they'll be getting a lot of attention. So, we can see currently CPI is very high, and it is expected to remain, well above target for quite a few periods there before ultimately in 24, 25 coming down to, a more reasonable range of 2.5%. What stands out there is the wage price index immediately below it. Where your wage price index growth is less than your CPI, essentially that real wages are going backwards. We know that's the case, but the numbers in the forecast really play it out, and you don't see wages catching up, or not even catching up, wages exceeding that growth until 23, 24, and even then only marginally. You can see in the current state quite strong GDP growth, and that's reflected in the deficit number being lower than budgeted, so that's generating higher than budgeted tax inflows, but you can really see that coming off in the tail end of the forecast period. So, that's not expected to continue.
So Marcus, that indicates a potential recession. The government's looking at a potential recession. Let's use the word, because they're looking at negative GDP in next financial year. Whether or not it's enough to be able to create a recession, or whether or not it is a softer landing, because it's not a crash landing based off -1, and it could only be for 1 quarter if we come back out of it quickly. So we don't get the technical definition, which is the 2 quarters of negative growth, but we are trying to, that's what they're playing around with interest rates, is to try and drag demand down to be able to get this GDP and inflation under control without creating a recession.
I think, that's exactly right. If you trawl through, you get the impression, I think, that the Treasury are hoping that we can avoid a recession, or even if we do have one, it will be, brief. But the numbers are very close either way. So, I think the honest answer is they're not sure. It really depends what happens over the next 6 to 12 months.
So they're planning for the worst, hoping for the best.
Yeah, I think that's a good way of putting it. But in saying that, if we jump to the next slide, you can see the underlying deficit forecast for the next few years' budgets. And, concerningly, what you can see is that it's getting bigger, which is not what we want. And so I think we'll hear more said about, or more discussion in the years to come about the structural deficit of the budget, meaning essentially we have a structural issue where our inflows into the budget are lower than our outflows, which is, clearly a problem. I've got up there on the screen, what does that mean for the future? It's not entirely clear if you read through this budget, but, one has to think that the government is going to, in future budgets, want to do more work to try and deal with that structural budget. What does that look like? I guess at this point we're guessing, but, the discussion points will be around whether or not there's further activity around tax increases, and also, where spending can be cut. So it's interesting.
So that includes the tax cuts coming through in 23, 24. Sorry, 24, 25. So that includes, and that's why it jumps up there. So if that's going to reduce the revenue, obviously, and have that impact, it's going to drive the economy, which hopefully drives growth, which means that there is more revenue coming in out of companies, I would assume, at that stage. But there's obviously a logical jump to change the tax structure as well if we're moving more towards that 30% regime, where we look at the GST, obviously, at that point.
Yeah, I think it's a really relevant point about the stage 3 tax cuts, and that's why I think there's probably more discussion to be had. I think it's also interesting to note the other things that are driving on the expense side. I think there was some fairly concerning forecasts in the budget around the increasing cost of funding the NDIS. And the other thing that we have to be mindful of is that, much like households, the increase in interest rates is really hitting the government bottom line too, with the cost of paying down government debt significantly increasing.
Helpfully, the dollar went up today, so that should mitigate some of it.
Let's hope it keeps. But yeah, there's a bit of volatility there as well, which will be interesting to see what the impact is. So if we jump to the next slide, the ABS released the September CPI figures yesterday, so we thought it was relevant to put them in there. And I guess the headline is that they were very high still. So the annual CPI movement to September is tracking at 7.3%, which is the highest since 1990. And even the adjusted inflation number is at 6.1%, which is the highest since those figures started being published. And the graph really, if you look at the end of it, shows graphically how quickly things have escalated. What can we take from this? Well, the next interest rate announcement from the Reserve Bank is next week. The CPI numbers released yesterday have probably skewed the market a bit to think we're more likely to see something closer to 0.5% than 0.2 or 0.25 that might have been anticipated before these CPI numbers. But essentially it spells out we're still seeing very high inflation pressure as it stands.
And the RBA almost went 0.5 last month, and they were holding out for this number to see what it looks like. They still went 0.25, right? And this is higher than what they thought. So logically, it's more than likely, I think, that they'll go strong now, because they don't really want to be giving a great message in December, but they'll probably put it up again in December as well. Because we're talking about getting to 4% relatively quickly.
Yeah, and I think it's interesting that the budget, I think, kind of forecast interest rates not hitting that 4% mark. I think they had them more at the low threes. But, if you price in 0.5% next week, we're very close to there already. So, that could really change things.
But if you look at that CPI, you just need to do something, and it's obviously a material issue right now.
Definitely. And globally, our Reserve Bank was a bit of an outlier last month in shrinking its interest rate increase. Next slide. So what's driving inflation? And these are probably some relevant talking points and things we'll be seeing a lot of. There are other things, but I think the main things we'll be talking about are energy and gas prices, particularly over the next year or two. That's going to have a big impact, across the board. Low unemployment. So people are in the workforce, they've got income and they've got money to spend, which is driving demand for now. Fresh produce, we've seen some funny things already. We all remember the price of lettuce a few months ago, but I suspect that some of the recent floods may further exacerbate some of the cost pressures on fresh produce. And there's also still some funny things happening on the global supply side. So obviously there's still some hangover, I think, from COVID. There's strange things or impacts coming out of the situation in Russia and the Ukraine. There's also still a fair bit of discussion around what the impact is of China's ongoing zero COVID policy. So there's a lot of factors driving inflation still.
Yeah, there's been another lockdown in China, I think, of an area overnight, and that'll impact their production again.
Yeah, I think they've really doubled down on their zero COVID policy. So that really is an anomaly in the world at this point, and potentially has significant flow-on impact.
And on unemployment, there's obviously wage growth as well going on at the moment, but it's not real wage growth still. It's still underneath this inflation. So wages, and this is where you get the treadmill effect, where wages start trying to catch up to keep track with the growth in the CPI, so that the people can still spend the same or still buy the same amount of goods with their money. But because that keeps wages trying to keep catching up, creates more inflation, which drives prices higher, and it just keeps going round and round and round until you break this demand cycle.
Yeah, I think that's exactly the concern. Once we get stuck in that cycle, it's very hard to get out of it. So, looking at the numbers, I think the government Treasury is still forecasting that we can break that cycle before it becomes entrenched, but we are, in somewhat unknown territory. So moving along to the next slide. Oh, great. Now we get to talk about tax. This is what I know everyone's here for. So I think the tax measures in the budget very much reflect that economic position. That is, we need to collect more tax revenue. I think at the moment, these policies are kind of skating around the edges of probably what needs to be done. So I think there'll be more to come, but I think the theme will continue. So I think you can put the tax measures into three buckets. Bucket one is funding compliance action to increase collection. So, enforcing the rules that already exist. Bucket two is trying to increase tax revenues, and that has a particular focus on multinationals. That's a focus I suspect will continue in the coming years. And finally, just some other general measures which have fairly focused application. So I'll go through each of those buckets, and I'm sure if I get too carried away into the detail of tax, Todd will pull me back. But
you can be sure of that, Marcus. You can be very sure of that.
Everyone's here for the tax, Todd. So firstly, on compliance measures, the government have had quite a bit of success over the last few years in funding targeted compliance programs at the tax office, in generating some fairly significant amounts of revenue. And I think they see that as win-win. You collect revenue for things that have been done wrong in the past, and you also change behaviour going forward. So at the moment, what's been announced targets 3 specific areas. So there's a program for personal income tax. I've put the costs and the estimated receipts, so the additional revenue that will be generated out of these measures, up on the screen. That personal tax measure is focused on individuals who are non-compliant, who are overclaiming deductions, or who are incorrectly reporting income. The second one up there is the shadow economy. These are your more egregious or dodgy taxpayers, so to speak. So that's really going after the bad stuff that's going on in the economy. So people who aren't reporting, who are committing fraud, who aren't paying wages properly, who are evading tax, and who are committing illegal phoenixing activities. Politically, that's an easy win, I think, to go after those taxpayers. No one's going to be upset to see those taxpayers, fined or have to pay their fair share. And I think where the real meat is the tax avoidance task force. So an additional $1.1 billion has been committed to funding the tax avoidance task force, which pursues areas of observed business tax risks, particularly focused on multinationals and large public and private businesses. If you were to consider all of those things and take a step back and consider, who does this affect, or what type of taxpayers does this affect? The answer is kind of everyone. So there really is going to be a compliance focus on all taxpayers in order to make sure that our tax receipts are as high as possible. Jumping onto the next slide, then we'll dive into.
And Donna will give us a bit more detail about how the ATO is actually going to go about that, and who they're going to chase, which is relevant for everybody because they're obviously amping up everything.
Well, they got lots of money now.
Yeah, but they want more. They want more, Donna.
Never enough. One of the big focuses in policy for the last few years, and this isn't just an Australian policy, it's a global policy, and a lot of it's coming out of OECD measures, is a focus on multinationals, and as I think the policy would say, is making sure they're paying their fair share. And so there are a few very specific measures in here. There are some existing rules that have been in place for quite a while around thin capitalisation. These are rules that limit the debt deductions that global businesses can take in Australia to make sure that excess debt deductions aren't happening in Australia, where we have a generally high tax rate, and so you get the most benefit. These changes are fairly significant. So there have always been 3 tests. The first 2, the safe harbour and the worldwide gearing tests, have been modified so that rather than being based on a limit based on debt equity ratios, they'll now be based on a limit based on a portion of deductions over EBITDA, which is a really big change. So it will have a fairly focused impact. It's estimated to generate $720 million of revenue, but for some taxpayers will be a really big problem, especially those that have forecast out, have financial models, have forecast out their returns, and are now going to have some deductions potentially denied. That measure comes into effect from 1 July 2023. So if you are a taxpayer that's already impacted by the thin capitalisation rules, you really need to be putting some thought into how these changes would affect you, and whether or not you need to do anything to change your structure to keep generating the returns that you previously had. On a similar trend, there's a measure for denying debt deductions for payments relating to intangibles held in low or no tax jurisdictions. It's fairly common globally for multinationals to park some of their intangibles like IP and trademarks in low or lower tax jurisdictions, and they might pay a royalty out of all the countries that they operate in over to that low tax jurisdiction for use of that intellectual property.
That would be called proper tax structuring, I would have thought, Marcus.
Well, traditionally, yes. it certainly would be. And increasingly the focus at an OECD level, and I think this is what we're going to see a lot of in the next few years, is making sure that the profits of businesses ultimately end up being shared across all of the jurisdictions that the revenue is actually generated in. That seems to be the end goal, and this is skating around the edges.
The US sort of rule with that 15%, you got to pay 15% roughly, and that's why a lot of the larger corporations are repatriating cash to be able to sort that out, because that's a sort of reasonable level for them.
That's exactly right. And there's already some consultation on this. I think there was a consultation paper that was released previously, and it draws comparison to some of those US rules as well in terms of what's already going on. So it's a global trend. We'll see more measures like this, I think. And finally, there's been some funds committed to improve tax transparency. Those of you in the virtual room that are accountants will know that the admin burden or the reporting burden for most businesses is ever increasing. And that's really a focus. I think that the tax office and the government really want to collect as much data as they can. What they'll do with that, well, the receipts in the budget papers are unquantifiable. It is just data collection, but it will inform policy going forwards, you'd have to think.
So for $17 million investment, where the aim is to get about $1 billion plus back out of it.
Yeah, it's a very healthy return on investment.
That's the type of government investment I like seeing.
Certainly hasn't mimicked any of the returns on my own investments.
You don't have
jumping
crypto?
to the next slide. We don't talk about it, Todd. There's then a few other general tax measures. Some of the more significant ones I've put in this table. So there's been a fair bit. I think the AFR didn't like this one. They had a few articles up yesterday improving the integrity of off-market share buybacks. So there's a bit of concern in the market, I think, that certain investors, particularly large institutional super funds, are really keen on off-market buybacks from big listed companies because they get a big benefit out of the franking credits. The government and the tax office seem to have a bit of a focus on how franking credits are used at the moment. So they'll essentially prevent that from happening. So public companies will only be able to do buybacks as capital. So no more franking credits coming out of public company buybacks. There is another measure floating around that was announced in the last week or two on a similar trend around preventing the payment of dividends, franked dividends that have been funded out of capital raises. So you can see this as a focus area. Already announced also is a discount on electric cars. So there'll be no FBT on the lease of electric or certain environmentally friendly vehicles. So that will really benefit potentially employees intending to purchase an electric car. There's a couple of funny things in there. Well, that's the thing, if you can get one. And also the reportable fringe benefit amount is still required to be included on the employee's annual payment summary. So the business still cops the burden of having to calculate the FBT and doing all the work. It's just exempt. So
I had an interesting question on this the other day that I'll put to you now. Does the FBT calculation need to include if you are charging at your office?
I don't know that there's an answer to that one.
Yeah, so there's one for you to take
I think
offline.
it would, because it's included in the fuel, just like a petrol would be.
Yeah, but how do you calculate it? So then, so that's what I mean. FBT is complex because of the calculations, not because of the real quantum, but it's just complex. So there's all of those things that will change as we move across more into EVs being part of the business.
It's a very good question, Todd. And yeah, we're going to see lots more things like that.
Don't get distracted. Keep going.
There's a slight expansion to some super measures. So the downsizer contributions measure. So this is where I've put downsize in inverted commas because you don't actually have to downsize. But if you're between certain ages and changing your main residence, you can make additional contributions into your super fund, a really good measure. That's been expanded. Previously, it was for people over 60, and it's now including people over 55. That's not anticipated to have a huge impact, but it's a good measure.
It's more to create more housing stock, I would have thought then, and as part of those measures.
Yeah, and make sure the right housing stock is being freed up, and that people aren't artificially staying in their homes because of the financial implications. And there are also some complementary adjustments to the way the pension is calculated, or the impact of selling or being between houses when you sell your house and you've got that cash in the bank. So yeah, that is a focus. And on the next slide, I've just got a couple of the extra measures sitting there. So there's extra funding for the Tax Practitioners Board. That's the board that oversees us, your tax agents. So they're cracking down on dodgy tax practitioners. The government had previously announced some measures to allow taxpayers to self-assess the effective life of some intangibles. They've scrapped that, so that won't come into effect. There's some increase in fees and penalties in relation to Australia's foreign investment framework. And on crypto, Todd, there will be some measures released that clarify that digital currencies are not taxed as foreign currency, which is not a change. That's already the policy, but they'll be introducing some measures to make that clearer. Then on the next slide, we've got the hot topic, stage 3 tax cuts. I've put some news snippets up there and also a tweet from Adam Bandt, the leader of the Greens, who very much doesn't like the stage 3 tax cuts. The question will remain, I think, around whether or not they'll be adjusted. I think it's really important to remember that they don't come into effect until 1 July 2024. And on 1 July 2024, taxpayers who are at the top of that tax bracket, so people earning $200,000 or more, are not going to be written a check for $9,000. Really, it's going to hit gradually, incrementally over that 12-month period in their pay packets. So the full effect won't be seen theoretically until 30 June 2025.
And as we talked about, and where the economy is going at that point, we may well be in a depressed economy. Let's not use the recession word, but we may be in it. So it may well be a way to put stimulus gradually back into the economy and give confidence to people to spend some money, which is maybe what the economy needs at that stage. So it is logical to leave it on the table and assess as we get closer to it.
Yeah, I think the government's approach in not amending these or adjusting these in the current budget is a bit of a wait and see.
And they made an election promise, Marcus. Let's be serious. They made an election promise. You've got to stick with some of them.
Well, that's why I think we'll hear more about it, because I do think if they do decide that they want to go down the path of changing these, they'll really want to whip up support, voter support for it if they're going to go back on a promise.
And so you'll be happy to know that Joel's asked you and put a question up for you, or a statement. Is charging at work on premises a benefit? So we'll leave that one floating around as well.
Joel's our in-house FBT expert, so I suspect he already has a view on the answer.
He's just looking for yours. Keep moving.
Yeah, look, I suspect there'll be some sort of exemption when the question comes up, but yeah, it is a good question. Jumping on to the next slide, high-level overview: who are the winners, who are the losers, what was missing. Big winners, probably construction and builders down the track. Some winners in the education space from additional funding, people who want to buy electric cars if they can find them. Families, kind of. So families, I think, who will benefit from the paid parental leave scheme and the additional childcare down the track will be winners. Losers, probably households. Real wage growth is going backwards. There's no measures in there to help with electricity and gas price relief. So households will probably suffer in the short term. Non-compliant taxpayers, the ATO is coming for them, and multinationals are being a little bit squeezed around the edges. What's missing? Not a lot in there on structural tax reform. So there's nothing that really deals with the structural deficit that the budget is in. So I think we'll see more in the future on that. And there's going to be a lot more chatter around some of those cost of living pressures, particularly energy costs, and that was really missing from the budget.
And one of the other things I noticed was that there wasn't real investment in cyber sort of security or any of that sort of thing. I think government's still leaving it to corporates to try and do it. But given what we've seen with a number of large corporates recently, the government's probably going to have to get their hands dirty a bit more.
Yeah, the chatter at the moment seems to be around whether or not they'll deal with it by just putting really big penalties in place and maybe making the private market deal with it, or whether or not they'll actually introduce the measures themselves. But yeah, it was lacking from the budget itself. Onto the next slide, which I think is my final slide, which isn't even about tax. We've thrown some commentary up there from Stephen Koukoulas, the Kook, a fairly well-regarded economist. His quick recap of the budget is that it seems like good policy, it's sensible, and the RBA will also be pleased that it's not adding fire to the inflation flame. And in a bit more in jest, I think pointing out we probably need to manage our expectations a little bit of what we're going to get out of budgets, given the overall budget and economic position. So I think that's the overview from me, and I'll now hand over to Todd and Donna.
So thanks, Marcus, for talking about one of your favourite topics, tax. We'll get into one of my favourite topics, which is about the ATO engaging in collecting debts to make sure that everybody is paying their fair share. And we have an expert who's been inside ATO and has a unique aspect for it. Donna, do you want to take us through how this has occurred in the graph?
Thanks, Todd. So what Todd's alluding to is that I recently left the ATO, came back to HLB, I saw the light. And I guess I've got a bit of an inside look at what goes on behind closed doors.
And why they do things.
Yeah, I mean, it's great perspective. They do a lot of great work there. There's a lot of smart people, working for the community and to protect the integrity of the tax system, which is actually really important for our society and to pay for the things that we need, and obviously the budget. So I guess just on reflection, as you can see, pre-pandemic, the total tax owed to the ATO was sitting around $39 billion back in January 2019. And then I guess, given the sort of things that have happened in the last 2.5 years, we've had pandemics, we've had natural disasters, that amount where the ATO has really sat in that caretaking role, trying to support Australians through those things. So, not actively going after debt collection or not really using their
enforcement powers
and really focusing on, administering the stimulus payments and things like that. Basically, that amount owed to the tax office has ballooned out to $61 billion in January, to where we are today, where the ATO now have refocused their efforts and getting back to the job at hand and what they're designed to do, which is to collect revenue. And
you'll get to how they're getting that back down through a number of measures, but they're using their normal tools. It's just going to be it's probably not going to be a great smash down. It's going to be gradually winded up, and obviously it reflects in the way that the ATO is now getting funded to chase recalcitrant and non-compliant taxpayers as a particular area of focus.
Yeah, absolutely. But also, Jeremy Hershon, who's the second commissioner, he spoke at the tax summit last week, and he did say that they're going back to business, but they're not going back to the same kind of philosophy that they used to. They're being much more strategic about where they're going to focus their efforts. They've got limited resources like everybody else, so they need to be really targeted in their approach. And as you said, they will be funded for particular focus areas. As you can see, there's a task force going after the multinationals and the individuals and the shadow economy, and they'll be specific. That funding is tied to specific outcomes that they'll have to achieve, which sometimes can be quite difficult.
So for the accountants on the call, some of the things that they need to be considering here, because the ATO is going to get more active and they're going to be doing more audits, and they're going to looking at the data that they have access to now. So what are some of the things that they should be thinking about?
So, obviously when you're dealing with the ATO, compliance is key, and having that good compliance history. So keeping on top of your lodgements and payments, and even the ATO is pushing this, their strategic management division was changed. They changed their name to Lodge and Pay. They're really trying to change that culture of taxpayers to, voluntarily comply and making sure that you're keeping on top of your obligations and not letting it get on top of you. So if you're an advisor, being in touch with your clients, making sure that they're lodging on time, having conversations with them about what's going on in the business. If they're doing well, that's great. Just keep up the good work. But obviously in the current economic environment that we're in, some businesses might not be doing as well. So reach out to your advisors and have those conversations about, we don't think that we might be able to lodge these. Well, you can always lodge on time, but potentially might not be able to make the payments, and what your options are about that.
Because there is a cash crunch coming with Christmas this year, which may inhibit some businesses, and obviously there are businesses that are sitting there with debts pre-COVID or built up during COVID when they didn't necessarily have the same cash flow that they need to manage and deal with the ATO now to be able to take the next step forward. And on your next slide, you've got some of that noise that's coming through in the marketplace around what the ATO, how the ATO is sort of driving people back to them, and focusing on that small business, because obviously it's a large number, 60 odd billion dollars, but it's spread across a number of taxpayers. It's not sitting with 10 to 15 of the large resource businesses.
Yeah, absolutely. And I think 65% of the current amount outstanding that the ATO's got on their debt book sits with small business. So it's a big concern for them. And because also, the tax gap there, I think, sits around 94%, which is still higher, I should note, than the multinationals. And this is based on lodgement. So when small businesses lodging, they get it right 94% of the time, even with the limited resources that they've got. Whereas multinationals or the large end of the market, they're much more sophisticated, technically should have more resources. They're getting it right 92% of the time. So, kudos to the small business owners for doing the right thing. And the ATO is working on improving that through the digitalisation of the tax system for small business. So they understand that they don't have as many resources, and they really do want to make it as easy as possible for them to be able to engage and voluntarily comply. So, talk to your advisors about getting a lodgement deferral if you don't think you're going to make it on time. Talk to your advisors about getting a payment arrangement in place. And you really don't want to be accumulating debts owed greater than 90 days. The ATO now for businesses can actually disclose your debts to credit rating agencies if you start to have those outstanding debts. So it's no longer a hidden debt you can't go for financing and say, oh, no, I don't have any ATO debt that's sitting there. The ATO actually will start to disclose that. You will get a letter telling you beforehand that there is an intention to notify and to disclose this information, and you can do something about it within those 28 days. But the real key is to get some action done and not ignore it. Don't put your head in the sand and think it's going to go away.
And so the other things with those sort of aspects is again, audit insurance should be something that everybody should be considering, just to try and mitigate the risk of those costs, to keep that. Because even for good taxpayers, if they're going through an audit regime, there's going to be that issue arising. So it's a cost that you don't necessarily want to pay for. I mean, we all love paying tax, but we don't necessarily want to pay more money for the ATO to review to make sure we've paid enough tax.
Absolutely. So audit insurance is really important, because you're only insured it's like any other policy. You're only insured for the time that you've got it. Not for the years that it was covering. And, with the ATO, they've got so much data now. They're a data-driven organisation. And there's so many different risk matrix that they're using, and every team's got a different risk that they're looking at. So, it's very likely that, with this ramped up activity, that there will be a lot more of our clients even potentially getting a look in from the ATO.
It's just that goes with more compliance. But some of the things that they're doing, and then we talked about yesterday, is like those 50-50 deals where you have a genuine dispute with them, and how do they work?
Yeah, that's a really good point. So, you could get into an audit with the ATO and you might disagree with the outcome that they've decided on. And so then you've got a debt which is sitting on your book, which is accruing interest. the general interest charge of 9.31%, which is quite high. And that will accrue the entire time that you've got this dispute ongoing. And what the ATO can do, and actually the taxpayer can request it or the ATO can request it, is this 50-50 arrangement. So if you pay 50% of the underlying tax debt, you don't have to pay the GIC and the penalty. Basically, it stops the clock on the interest on the other 50%, and the ATO will remit the 50% interest once the dispute's been resolved. But there's a few things that you need to do, which is make sure that all your other compliance is on time and paid up to date, and also that you provide all the relevant information for a timely resolution of that tax dispute.
So that's a good way to sort of, yeah, you're right, to resolve those issues and move on. And there's a few other things that people should be like. I think that tax debt would be great for people in business being able, if they have concerns around their customers or their suppliers or whatever else, being able to see that and use that then as a sort of way of governing and checking on those key parties to be able to say, well, do we want to place this order with these guys? We're really concerned about them, and as a leverage point to ask more questions. Yeah,
it's useful information, isn't it?
It'd be very commercially it would make a lot of sense to be able to utilize, and I'm sure somebody will work out another way to use it nefariously, but hopefully it just leads to a lot of those people paying down their debts probably to 50 grand, so that they're not above the threshold, and that could help fill Marcus's budget hole.
Well, look, you do want to have a good compliance history with the ATO, because it does help with things like getting payment arrangements in place and looking for those remissions of general interest charge if you end up having a bit of a slow payment arrangement with them. And ultimately, it's just good business, right?
Yep. And speaking of business, I'll use that to thank you, Donna, and hand over to Ashy, and Ashy can give us a feel about what private and family businesses are talking about at the moment, following all of the things that are happening in the economy and the budget this week. Ashy,
yeah, perfect.
Welcome aboard.
Thank you, Todd. Thank you, Donna, Marcus. Yeah, so my name is Andrew. I specialise in family business. I spend a lot of my time, family businesses are unique, and I spend a lot of my time helping business owners, I guess, solve problems and make decisions. I'm a chartered accountant, so tax is my bread and butter. But because I work in family business, I actually deal with a lot of other issues. I can give you a bit of insight into, I guess, what other family businesses are going through at the moment and what they're kind of seeing. I think there's three key themes that keep, I guess, recurring coming up. The first is staffing issues. The second is cash flow constraints. And then the third is, with a down cycle, finding opportunities within a down cycle. There's a lot of conversations around that. So I suppose, firstly, I think everyone is aware that it is hard to find staff at the moment. It doesn't matter what industry you're in, doesn't matter what size of business you are, everyone is struggling with it. And as a result, staff have the ability to demand more flexibility and, higher pay, and so on. So a lot of business owners that I'm talking to at the moment, they need to be a bit more creative to actually find the talent. So what are some of the businesses doing about it? So a lot of businesses are trying to do a little bit more with less. So I'm having a lot of conversations around technology and how business owners might use technology better to be a bit more efficient. So doing more with less. Upskilling existing employees. So if you've got some good employees there at the moment, and there's positions to be filled that maybe are slightly different to their current roles, considering upskilling them. There's a lot of businesses that are trying to do that. One point that I would, I guess, a bit of a learning that I'm seeing with a lot of businesses is in terms of culture. So don't compromise on culture. I've seen business owners, they've needed the staff, so they've just gotten anyone they could grab. But getting a bad egg on the team can do a lot more damage than just waiting for the right person to come along. I think also family businesses are quite unique in the fact that, you know, there's often multiple generations working within the business. So their cultures are quite unique. And they're also unique in the fact that they're very long-term in their thinking. And I think both of those two things are a bit of a competitive advantage for those businesses. And I think it's a bit of a learning for all other businesses, that if you can have a bit more of a long-term view and really focus on culture, then you're probably more likely to be able to attract more people. Obviously, you've got to pay them the right amount. You've got to be competitive, and you've got to provide some flexibility. But there's some other non-financial ways that you can attract more employees. So that's a bit of a learning from a staffing point of view.
And actually, that long-term view is sort of applied to how they're going to deal with this current inflation issue. They're probably taking a more of a longer term, we've just got to ride it out sort of thing, rather than being more aggressive. Is that what you're feeling in the market?
Yeah, that's exactly right. So especially with, you know, multi-generational businesses, they've seen a down cycle in the past. So I think planning for it, I think and it'll come to, I guess, the last point is opportunities. So a lot of them they know that there's opportunities in a down cycle. So getting ready for that, forecasting where they are and where they think they'll be, and then getting ready for opportunities as they pop up, I think is really important. Which I guess brings me to cash flow. So the business owners, the family businesses, I think all businesses at the moment, they're seeing cash flow get tighter and tighter. Margins are coming down. Overhead costs are increasing. Debtors, especially over the last 2-3 months, definitely I've seen a lot more clients complain about the collection of their debtors, which is quite concerning. And a lot of them are forecasting either flat or no growth for the coming year. Some of them are even forecasting, declines. So
is that concerning, given that you've got Christmas coming up? So that could cause a cash contraction when you've got unusual things like having to pay annual leave out for January if you're closing over that period in the Christmas period.
Yeah, definitely. So yeah, offices generally shut, just before Christmas, and people don't usually come back until, Australia Day. You don't really have everyone fully on board. So planning from a cash flow perspective is really, really critical for this time of year. I'd probably also just note that, the construction industry, it's been raining a lot. I don't know if everyone's noticed that. It's been wet. But these businesses they still have to pay their staff. So, and we're looking at the rain to continue into next year as well. So for those businesses in the construction space, they really need to forecast out and make sure that they have enough cash to get through these periods. So scenario planning, I think is really important. So, what happens, if, for example, electricity prices increase by 40%, what does that look like? I think looking at all of your overhead costs and doing a bit of a spending audit. So I think that the Treasurer said in this budget, he's done a spending audit. So I would encourage, businesses to do the same thing. Look at what you're spending money on. I think when times are good, it's really easy to get a really overweight overhead. It's, when the cash is there, it's easy to spend. So I think having a detailed look at that and doing some scenario planning.
You get lazy.
You get lazy, and it's very, very easy. It's like staff. You get a pay rise, and it's very easy to spend it, and then you're like, where'd the money go? So that's very important.
I know where mine goes, mate. I'm sure you probably know, you have more control over your spending than I do.
Yours goes to crypto, doesn't it? Or
my wife might have something to say about that.
And then finally, so opportunities. So especially multiple, people that have been around for a bit longer, they've seen a down cycle in the past, and it can create opportunities. So opportunities to acquire other businesses, to buy assets, and potentially expand into other parts of the supply chain as well. So If we just go to the next slide. Yeah, so a lot of family businesses at the moment are asking me about finance. So they're looking at, okay, what can they're getting ready for finance. So they're trying to find, what their borrowing capacity is, especially personally when it comes to housing. There's a lot of talk about housing maybe flatlining or coming down a bit. So they're really getting ready for that. So, but before you can find opportunities, you need to get your cash flow. You need to be on top of that. So you kind of need to do it in order. The last thing out there I'd just probably note is, in the budget, there's a bit of spending in a few areas. So I think there's an aspiration to build 1 million homes by 2024 or just after. So potentially in the construction industry, maybe there's some opportunities that may arise in the future. So yeah, that's what I'm hearing from family businesses, and yeah, pass back to you, Todd.
And actually, we've talked about it previously. Even if you're buying a business which is in a little bit of distress now, this is that opportunity where you can buy something, say that's for 3, but if you bring it in with your management structure and bring it under your culture, you can turn it into something worth 10.
Yeah.
And obviously there's a multiplier into your business if you can get that right as well. So that is a unique scenario here, and there is extra layers of funding available from, let's call them non-traditional. So there is those things available if people want to look at those and take a shorter term sort of viewpoint rather than locking in a longer term finance facility of with a large bank. You may, just to take advantage of the opportunity, just do something faster with a different funder.
Yeah, definitely. And I think with all of that, starting the conversation early and planning for it before, because you don't know when the opportunity is going to arise. So I think start like flagging that, with your accountants. I think nice and early is really important because there's a lot of ways to cut it.
So we'll ask for questions, and while we're asking for questions, I'll ask for 2 key takeaways from Marcus, Donna, and Andrew. Marcus, it doesn't have to be tax.
But it will be. I'd say probably we can expect more tax changes down the track to deal with that structural deficit, and I think also a lot of what the tax policy is focused on is going to depend on where the numbers land in terms of inflation and GDP over the next 12 to 18 months.
Donna, what would you be suggesting to people?
Engage early with the ATO, talk to your advisors.
And understand your position, make sure you understand it.
Yeah, absolutely. Make sure you've got good compliance history, talk to your advisors.
Get a good advisor like yourself.
And Marcus, definitely. But yeah, just make sure that you're engaging. Don't put your head in the sand. There's things that you can do. The ATO are there to help, and there's a lot of strategies that they can deploy.
Okay. And Ashi, get organised.
Yeah, I think plan and forecast early. I think is super important. Get organised. And if your budget looks like the budget that we just received, 5 years of negative P&L, talk to us, talk to Todd.
We can fix some of those things.
Yeah.
So if we have any other questions,
I think there is an FBT question in the chat. Just so around whether or not you can.
Yeah. So does FBT exemption on electric vehicles below the luxury car tax threshold include cars that were purchased for more than the threshold but subsequently refinanced with a valuation below the luxury car tax threshold?
It's a good technical question. I think the answer is no. So that the eligibility threshold is based on the first retail price of the vehicle. So I think that won't work, and it makes sense from a policy perspective. I think the policy is to try and get more of those types of vehicles on the road, not cycle through what's already there.
Okay, so that's a no. And then we have the poll for everybody to have a look at on the way out. Unless we have any other questions, I think that's pretty much it, Tanya.
Yep. I'd just like to thank Todd for hosting the webinar, and also to our panel of experts, Marcus, Donna and Andrew. Thank you again for joining us this morning, and we hope to see you at the next webinar. Thank you.
Okay.
Thanks, everyone.